So basically, when I got started trading, I did the same thing that everybody does. I went to YouTube and read books and done everything, learned all the stuff that basically doesn't work, and then through a serious process of trial and error, I failed miserably for a very, very, very long time. So basically, I studied the charts literally all day, every day for years and years. And I just started noticing these little nuances. Obviously, there's other stuff on YouTube that talks similarly about what the things that I discuss. I mean, they're out there, so you can find it, but I mean they don't talk exactly about the stuff that I talk about because what they're looking at and what I'm looking at aren't the same things. So basically I just developed this strategy basically because it worked for me, and over a long period of processing information and trial and error, this is the strategy that I found had the most success. And basically, that strategy is scalping, looking for intraday scalps for a day trades, looking to capitalize on the daily range expansion, and also targeting areas where retail traders are going to have their stops. Why do I know stop where? Why do I know where stops are? Stops are above every single swing high and swing low, every single one of them. You know what I mean? Because traders are taking trades throughout the day, all day long, 24 hours a day. The liquidity in the Forex market equals out to about $7 trillion a day, which basically dwarfs every other market combined in the whole world. It dwarfs it. Not only are people speculating in the Forex market as to what they think is going to happen as far as what price is going to do, the foreign exchange market is also where the China or the Bank of Japan say they need to offload a bunch of dollars for a pound. Well, they do it through here. They do it in the forex, the foreign exchange, the forex markets. So that's why there's so much liquidity. As far as what price, how does price move? Price moves from buy orders and sell orders. There has to be a counterparty to every single trade. So in order for you to buy, there has to be somebody at that exact specific time that wants to sell what you want to buy at the price that you want to buy. Otherwise, you would have to wait until a market maker paired you with somebody else that wants to do that. Well, unfortunately, if that was the way that it all worked out, it wouldn't happen. It is a free market. Market makers, the bulk of them, not all of them, there's several different strategies that market makers employ. The main one, or the one that offers the most liquidity to the markets, they offer liquidity on the buy side and on the sell side. What does that mean? Well, that means they basically have orders sitting on the buy side and orders sitting on the sell side to fill your orders. How do they do that? Well, essentially, they buy from, say, Forex.com's exchange and they sell to, let's say, Anda's exchange. Because, like in crypto, a year or two ago, you could see it in crypto really bad, where like Coinbase, Bitcoin's price would literally be like $11,500, and then on Binance, it would be like $12,100. So there's a discrepancy there in price. Well, market makers they get themselves situated with the exchange, and they get the right to buy from Binance and sell to Coinbase. So that provides liquidity. So like when you're looking at the order book or whatever and you see huge buys and huge sells and that you're letting that influence your trade, you really shouldn't, because there's no guarantee that that buy or sell that you're looking at is actually even coming from that exchange. So you may see a big huge sell order and think, oh, this is going to go down because someone's trying to sell 15 Bitcoins at 2,500 or whatever price. That's not how it works. That dude is probably sitting there on the ask because he's a market maker and he's already purchased the Bitcoin from some other exchange, and now he's selling it on this exchange, and it's called spot arbitrage. That serves up liquidity, that brings liquidity in the market. They have algorithms that do that. Market makers do not give two shits about where you want to buy or sell, and they don't care which direction you want it to go, and they absolutely have no idea where your stop is. It's all a farce. People think of these ideas to use them as excuses for their bad trade. Instead of looking at their bad trade and saying, what did I do wrong? How did I mess this up? Why did I get stopped out? They say, oh man, I got stopped out because the market maker, blah, 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 blah. It doesn't work like that, guys. Market makers are making money. They lose trades too. They can buy on one exchange and sell on another exchange, and in that split second, the price can adjust, meaning they just lost that trade. So they're not concerned about you as a retail investor, what you're speculating on, the direction of whatever asset you're looking at. They don't care. They do not care. They are not taking your side of the trade because they think you're a loser. They're taking your side of the trade by default simply because they're either offloading their position at that price at that time, or if you're a seller, they're buying that position at that price at that time. Not from you to take your other side of the trade, because they're spot arbitraging price. They're buying from one exchange and selling to another. That's why in Forex, when you look at different data feeds, there are slight differences, but they're pretty damn close. That's because they have arbitraged that edge out of the market. And in crypto, it's starting to become a lot less often that you see those big, huge, like $1,000 differences on different exchanges, because the market makers are arbitraging that edge out of the market. So once they get it, once they do it so often, eventually all the exchanges will be running on about the same premium. So just get the market makers, move the markets, and all that stuff out of your head, because that's not what moves the market. What moves the market is buyers and sellers, okay? And the aggressiveness of the buying and selling. The aggressiveness of the buying and selling is what moves the market. And if you have big spikes in price and then you get long and then you get stopped out because price goes all the way back down to where it just came from or lower, and you're sitting there thinking, well, how did anybody make money on that? Well, chances are nobody did, because everybody's hitting the bid, and then you got a big price vacuum, and then once people start to sell or whatever, that price vacuum gets swallowed up whole. Nobody knows where the market's going to go. If they did, they would be the richest person on the face of the planet. They would own their own country, simply stating. I mean, it's as simple as that. People have edges, and that's what you got to do as a new trader. You have to learn your edge. Jordan teaches a fantastic swing trading edge. I teach a fantastic scalping trading edge. So you have the best of both worlds. I strongly suggest you, as a new trader, learn Jordan strategies. Stick to swing trading until you have profitability. Once you have profitability, then you can set aside a small amount of capital and start to focus on honing that edge, sharpening that edge on the scalping side of things. Because scalping the markets isn't easy. It's very difficult. To some, intraday price action absolutely looks like noise. To me, it does not. I see what I'm looking for almost every single day. I don't win every trade I make, but I know what I'm looking for. So basically, let me just show you this real quick and then I'll get on with it. This is a massive rant and I apologize. A bar chart, if you look at a daily bar chart candle, you'll see like a line like so, and then a line up, and then a down, and then you'll see a little line coming off. So basically what that represents is the daily range. So if you look at a 5-minute chart for one day, for a whole 24-hour period in the Forex markets, and it's a down trending day, meaning there was a down range expansion, this is what it would look like. So basically, coming in from yesterday, you have price that does absolutely nothing, and then it'll have a little spike up to get people on the wrong side of the market, and then shoot down, make the low of the day, and then trade away from the low of the day until the market close. And you'll have something like that. It's not going to look exactly like that. Obviously, it's going to be more slanted, and vice versa for a long trending day. You're going to have at the open, price is going to move down, and then you're going to have it move up with jaggedy little intersections and make a high of the day, and then roll over and kind of trade out. You see what I'm saying? This pattern is what I'm looking for when I go into the daily and to every single day. When I go into the day, I'm looking to capitalize on a move like that. I'm looking for a daily range expansion, and I want to catch the bulk of that expansion. I'm not always right. Getting the daily biased is the hardest part about learning how to trade. So, moving on, getting into this trade. Let me get rid of all of these lines so I can basically show you what's what. So, where are we at? Okay. This morning, right here, 5:15 in the morning, I'm going to go down to a 5-minute chart so I can show you what I was looking at. Okay? So basically, right here, roughly, is the start of today's range. And it traded sideways, basically, all day. This is where we were this morning when I woke up. I was watching this buy right here, this area. Reason being is because the last market structure on a 5-minute chart was put in right here, okay, before it traded away, and then it pushed back up into that area. And you can see we closed higher, but then rejected, okay? I put a limit order right at the low of this green 5-minute candle. Right there was my limit order, okay? Once this candle came in, I set my limit order right there to sell short, targeting this low. Now, that's not a very big range, right? What is it? Maybe 10, 15 pips? Well, 20 pips, okay? That's what I was targeting. My stop just above that high. So that would have been roughly, not nothing. Let me get it. About a 5 or 6 pip stop. So that would have been a 5-to-1 trade. Okay? When price pushed up into this line, it absolutely hit my limit order, but did not fill me. Why did it not fill me? This little area right here in between the sell and the buy is called the spread, that 1.5. That means the spread is 1.5 pips currently, right now, from price. This candle, in order to trigger my limit order sell, would have had to trade 1.5 pips higher than my limit order to trigger me into the trade. So just because the price touched it means nothing. I usually calculate that. I do. This morning I made a rookie mistake. So price touched it, did not fill me, ran off and done exactly what I wanted it to do. Took out the low right there, and it went without me. I didn't cry, I didn't complain. I just brought it up in the chat. You know what I mean? That I made a rookie mistake. And it happens. And it's going to happen to you. And when you put your limit orders in, you have to remember you need to adjust for the spread. So what I should have done was, instead of putting it right at the low of this up closing candle, I should have put it 1.5 or whatever the spread was at that point in time lower. Then this push up would have triggered me into the trade and would have ran off, took me out of the trade right here. I'd have moved my stop to break even, and I would have got stopped out on this move up. So where did I take my trade? Right up here. Basically what I was looking at on an 8-hour time frame is you had a market closing structure low put in here. Then a trade down, back up, and then it looked like it was going to maybe go higher, but it didn't. We came back down and made a lower market structure. Okay? So, until this market structure is taken out on a closing basis, my direction for every single pop in price is going to be down, looking for this same thing. Down, a slow move up for sellers to re-engage, and then down again. Slow move up, sellers re-engage, and then down again. Obviously, I might be wrong on this one. I wasn't. The trade was successful. It was a 2.6 to 1 risk to reward. So the trade was successful. But I mean, ultimately, it may make a higher high, a higher close. And if it does, then and only then, I will look to target these highs up here because the market's telling me, look, dude, we're going higher, bro. And that's how I trade. That's all I do. I watch market structures and I watch where candles open and where they close. And if they're opening and closing and making lower lows and lower highs, then on any pop in price, which this was a pop in price, I look to sell. So let's get wizardry with it. Going down to a 1 minute chart. Back over here to where the magic happened. Now, this was a very small range trade, and I only took it because of what I was looking at on the charts. So basically, I seen this big push up in the markets, and then give me 1 second. I'm gonna try to pull this up real quick. Today is the 23rd. Let's go ahead and minimize it till it figures out what it wants to do. So basically, this is what I've seen. I had that 8-hour market structure level. Well, here, let me just put it there because I done screwed everything up. It was just, you just have to trust me. It was in this area here. Okay, it was like right in here or something like that. So let's just put a line there and pretend that was the line I was looking at. So when we pushed up in there on a 1 minute chart, people, this is a 1 minute chart. 1 minute, 1 minute. This is what I'm trying to explain to you, that price looks like noise to the untrained eye, but to the trained eye like myself, this is not noise. Okay? It's not. I see what it's doing. It's telling me what it's doing. So, what did I do? We got a rejection here. We made a market structure high right here. This close of this up closing candle and the open of this down closing candle. That made a market structure. Look what happens when price pushes back up into it. Fail, fail, fail. And then boom, strong push down. What is this strong push down? And it's not super strong. It's literally maybe 4 pips or 5 pips because we're looking at a 1 minute. But that's telling me that there's a willingness for this to trade away. And on the larger time frame, it looks like the absolute perfect spot to sell short, right? So then we push back up. I had my market order, or not my market order, I'm sorry. I had my order right under this little candle right here, this 1 minute candle. Let me stretch it out so I can show you. This 1 minute candle right here, the body of it. Boom, right under that. Okay, after we showed a willingness to trade away from it, this was your last up closing candle, right? It traded away. Then we went back up and retested that. Man, look how perfect that is, dude. You see what I'm saying? There's my order. There's my entry right there. Bam. So we dilly-dally. But look at where the market made a new structure. It made it lower. Okay? We got this low down here. And now we have this high up here. So when price pushed back up, I was in negative territory right here. When price was moving this up in here. But then we pushed up. My stop was right above the high of this candle. Right here. Right here was my stop. So yeah, I might have been sweating it a little bit because we made a new market structure high, traded in a range, back and forth, pushed up above this high, closed back below this market structure. Nothing could close above there. Once this happened, this pushed back up into this market structure right here, guys. Look at this. Look at this and see ya. Once we closed the 1 minute candle below here, I set my target in this area, in the middle of this candle. Now, I went to a 10-second chart. I can't do that on TradingView. I had to do it on Oanda, a 10-second chart, and found a down closing candle, a 10-second down closing candle, and that was my target. Let me see if this picture is brought back up yet. It is not. There we go. Here we are. Here's my entry at 1.22138. Like I said, there's my stop sitting right above that wicked up 1 minute candle. I was aiming. Oh, yeah, that was my target. Sorry, not the 10-second. I looked at the 10-second when this happened right here to see if there was something here, and there obviously was. You could see this wick on the 1 minute push down into something and then trade it away. So I knew as once we got a closure below this market structure, I knew my target was going to get taken out, and it did. And it was a 2.67 to 1 trade. Okay? And that's what I was looking at. These market structures are crucial. People don't realize it. They take it for nothing. Like, this is all noise. This is nonsense. This is not nonsense. This told me what it was going to do. It told me what it was going to do so much, in fact, that I took a trade targeting this last down closing candle on a 1 minute chart before we pushed up. The price is fractal. So if you're looking at an 8-hour chart in market structures, and you're taking your trades based on 8-hour market structures like swing trades or whatnot, you do the same exact thing that I just did on this 1 minute chart. I took this trade on a 1 minute chart just to show you that I know what I'm talking about. And I'm not bragging. I'm not boasting. This is not me saying, oh, you know, this is me telling you to focus on my videos when I'm teaching you guys, because it will change your life. I'm not kidding. This last down closing candle was my target. Look at this rundown here. Boom. Took me out of the trade. Look at this retest. This up closing candle. Look where its body closes. Like damn near the open of this candle. You see how this works, guys? So basically, years of failing, years of losing money, years of blowing up accounts, years of studying, looking at charts, getting in arguments with my loved one, my girlfriend, complaining that I spent more time looking at the charts than at her. It started to come into focus. I love that woman with all my heart, and she's still with me, and she will be till the day I die. But it's going to take you a long time. You're not going to get this stuff overnight. Even with me telling you what I'm looking at and Jordan telling you what he's looking at, you're still not going to get it overnight, because you're still not seeing what we're seeing, even though we're explaining to you or trying our best to explain to you what we're looking at. But that's all I wanted to do, guys. Just a quick video to show you that a 1 minute chart is not just noise. It is to the untrained eye. But when you have enough training and you have enough chart time, and you've done your research and your back testing, and you're failing and you're winning and you're failing and you're winning, eventually you'll start to see these candles for what they really are, which is a range of price for that specific time window. So a 1 minute chart means that's the range of price for 1 minute. And it's all fractal. It's all fractal, meaning it all works the same. It doesn't matter what time frame you're looking at. These candles test each other. If you have a push up, strong push up, the last down closing candle will probably be retested. When? We don't know that. But if we start getting lower closes, then we can look to aim for that area. And that's a high probable setup.